Welcome to the B.F. Anderson Techno Fundamental Report for May the 8th. I'm going to talk today about strategies when you feel that the market is coming off of a low. Now, we all know we've had a fairly substantial drop in the market in the first quarter so far. So it's a time for testing. Let the market pull you in. Don't force this. And what I mean about testing is you want to buy, like I want to buy 10 stocks is basically what I'm trying to do. 10% per stock, so I get 100% invested. Now, right now, I'm sitting on about 50% cash, and I'm 50% invested. So I do something called test buys. Think of it as you're drilling oil wells. Let's say you have 1,000 acres of land that you think oil is under, and you're going to say drill 10 oil wells. Well, if you start drilling the first well, it's a dry hole, and then you start drilling the second well, and it's a dry hole. Your testing is not working out too well, and you may need to either get another geologist to advise you, or you need to just find another piece of property that is more beneficial. So it's like you're going to make mistakes. You're going to test buy, and what I mean by test buy is you normally buy, and this is what I do. You buy half what you normally do. So in other words, if I'm going to put 10% of my money in a stock, I'll start out with a test buy of 5%. Now, if it doesn't work out and the hole's dry, I can sell the stock and just move on. But keep testing, And so in this particular case here, you get one bullseye, and that's what we're trying to do. Now, I wanted to talk a little bit about William O'Neill and one of his associates named Mike Webster. Now, William O'Neill passed away in 2023. Now, I started first working with the O'Neill organization back in 1982, and I'm still with them today. And Mike Webster was a understudy of Bill O'Neill, and he recently came out with a very interesting checklist. Now, he's known, Mike Webster is known as Webby, and basically, this checklist, you have to think of it like you're driving a manual shift automobile. So you get a follow-through day. Well, that would, just say this. You're in cash. The market bottoms, and then you get a follow-through day. So you shift into gear one and maybe nibble a little bit, do a test buy. Then you get subsequent follow-through days. And then you close above the 21-day. Then your lows are for the index is above the 21 day. So you can keep going down the list. So let me just give you an example of why this is important. This is 1998. Now you can see here the market made a major top, then went into a substantial correction and made its initial low here. Then we got what you call a rally attempt. Now you did more than likely get some follow-through days in here. But if you're following the checklist, you would simply say, okay, I've got a follow-through day. I do a little nibbling. And is the low above the 21-day for 3 consecutive days? Yes. So maybe do a little bit more nibbling. So say you're second gear now. But here's the 200-day moving average, which we think is very important. So it acted as resistance here on this initial low. And then we pulled back again. We got what you call a W bottom. See, if this would have been a V bottom, it would have done like this. But this is a W bottom. You see, it looks somewhat like a W. So you came down, and it looks like you made a major low here. But then you got a follow-through day, and then you got subsequent follow-through days. Then you got above the 21-day moving average. Then you got above the 50-day moving average. And then you got above the 200-day moving average. And things really were starting to look pretty good. And your test buys, you were adding to them as you went. And so you ended up being fully invested in a new bull market. So let's look at where we are right now. We've made a low on April the 7th on the NASDAQ. We got somewhat of a follow-through day here, but we didn't get a volume confirmation. So it was somewhat of a follow-through day. Then we came on down and got back below the 10-day moving average. But then we broke out, and this is where we are, this is where we are now. So in other words, we got above the 21-day. We held it for at least 3 consecutive days. Now we're above the 50-day, and we've held it for at least 3 consecutive days. So things are looking better. And so if you look at the S&P 500, similar situation. Now, like I say, getting above that 200-day moving average is very important, and we're real close. I mean, we're within about 1% of breaking above the 200-day moving average. Now, the jobs report came out last week. We're still at 4.2% unemployment. So the big talk is, are we going into recession? Well, unemployment looks pretty stable to me. However, Jeffrey Gundlach, I just learned about this indicator, and it's interesting. What he does is he takes the monthly unemployment rate and he compares it to a 36-month moving average. And what he points out is that when you break above that 36-month moving average, it usually indicates recession. So in other words, this is the unemployment rate going above the 36-month moving average. Now, he back tested this, and as you can see here in 2008, 2009, we did go into recession. Now, here's the next recession, which was the pandemic, and we got above that moving average. Well, he's pointing out that we are now above the 36-month moving average for unemployment. So he's saying that's going to indicate a recession. So we'll just have to see. Now, interest rates, the Fed came out today, left interest rates unchanged. The main word was everything is uncertain. That was the big word. There's just a lot of uncertainty about where these tariffs are going, what the percentages are going to be, what deal's going to be with China, and so forth. So I do believe that if we didn't have that uncertainty going on right now, I think the Fed would have cut rates today, because my power index is telling me they should be cutting rates. Now realize this is a free market decision here, a free market price. This is the 5-year Treasury yield, and over the last 125 trading days, that yield has dropped by 7%, below zero. And historically, that's usually been an indicator that the Fed's going to cut rates, so maybe they'll cut next time. Now, the volatility index, just want to make note of it. Usually you get market bottoms when you go above 50 and then below 30, which we've done. So hopefully we're close to a bottom, but like I say, if we go back and look at this chart and then we look at where we are now, we could have a retest, and that's just something to be aware of. So in other words, we've gotten the initial low. Now we want to see this get above that 200-day moving average and start moving, but it may not do that. It may come down and make a new fresh low. So we just need to kind of keep it conservative here. You don't want to get too aggressive, but we are definitely looking better. Price of oil is definitely dropping. So if everybody was really or if the markets were concerned about inflation, usually oil prices, go up. Because it's somewhat of an inflation hedge, just like gold. But you can see here the price of oil is, down below $60 a barrel, and is definitely in a downtrend. Now, the other indicator that we look at is the number of new lows on the New York Stock Exchange. We're seeing kind of drying up here below 40. We got back on April the 7th when the market made a low. We actually got a reading of over 1,000 new lows. But things have settled down now, and it's looking like maybe the worst is behind us on the tariff news. Now, this is the AAII bullish ratio minus the AAII bearish number. In other words, it's the American Association of Individual Investors. They do a survey of their membership every week, and they report it on Friday. Well, so you ask people, are you bullish or if you're bearish? Now, if the bears outnumber the bulls, you're below zero. And you can see here, we're getting kind of almost record readings of pessimism. Now, just think about this logically. Markets are designed to fool most of the people most of the time. So if you can kind of think like a contrarian, it could help you. So if you have any questions, please let me know. Things are looking better, but let's just keep an eye open for that second test. If it's coming, if it's not coming, we're off to the races. So let's just see what happens.